Hi there, welcome to RentPrep for Landlords. I'm Andrew Schultz, Community Manager here at RentPrep. I'm also a licensed real estate broker in the state of New York with over 14 years of experience in the property management and rental property industries. On today's episode, we're going to be talking about 5 mistakes that new investors must avoid in order to be successful. Learning from other people's mistakes is way better than making those same mistakes yourself. So let's see what we can do to help save you from making some mistakes today. The first mistake that I wanted to talk about is failing to do your due diligence before purchasing a property. Due diligence is essentially making sure that you thoroughly research your property and the associated costs before going ahead with the purchase. Your due diligence is going to include things like verifying that you're not overpaying for the property by looking at recently sold comps in the market, having a property survey done, having a title report researched and getting title insurance, getting a home inspector, and things of that nature. Due diligence is also going to be making sure that you're buying a property that's going to perform for you after you close on it. So for this type of due diligence, I recommend that you do a net sheet or an investment property deal analysis, something along those lines that's going to be based specifically on your property. We do have a free deal analysis tool available over at whatsdrewupto.com. You can pick that up for free. It also comes with a companion video showing you how to use it. But essentially, that spreadsheet is going to help you to run some numbers on your property to determine whether or not this investment makes sense for you or does not make sense for you, and you should just pass on it and move on. So for instance, you're going to need to know what your potential purchase price on the property is going to be, what you need to put in for repairs, what the current rents or future rents are going to look like. Especially if you're updating it, you're going to want to know, does it perform when you close on it? And is it going to perform better when you update it and put better paying tenants in? Things of that nature. You're also going to want income sources from other things, or at least know about what other income sources are available for things such as laundry and parking. And maybe if you're living in a major metro, you might have a cell phone tower or a billboard or something like that on your property. There are some other revenues other than just straight out tenant rents that would impact a property deal analysis. And it's important that you know all of the sources of revenue so that you know what you're truly dealing with. On the expense side, you'll need to know what the tax bills look like for the property, what utilities you're going to be responsible for, and roughly how much those bills are going to cost you. You need to factor in for things like vacancy and property insurance. You need to factor in for things like landscaping and snow removal, trash removal, things of that nature, any of the operating expenses that would be associated with the property. You also need to know what your projected principal and interest payment is going to look like. We did include a mortgage calculator in that spreadsheet, so if you want to go ahead and use that as you're doing your deal analysis, that information is right there at your fingertips. There's also a ton of different apps and websites out there that can give you that information as well. As for what makes a good deal versus a bad deal, that's going to depend on your market, your investment strategy, your risk tolerance, and things of that nature. But my recommendation would be look at other deals in the market that are successfully performing and talk to some other investors in your market that have done deals in that area to find out if what you're looking at is a good deal or a bad deal, especially if you're not sure and you're trying to make a decision on a first purchase. Our next mistake to avoid is underestimating the costs of your renovation work. This is a big one as it can completely sink a deal if you don't understand the cost of construction and how it relates to the property that you're rehabbing. If it's been a while since you've purchased a property or done any major capital expenditures, you need to be prepared for the fact that costs are much bigger now than they have been in the past. Materials have come down some since the pandemic highs, but they are still higher than pre-pandemic levels, and there are still some supply shortages out there, be it artificial or actual. They're still out there, and we are still dealing with some of that stuff. Labor is also at a premium right now. There are fewer people out there entering the trades, and there's also more people looking to have work done on their homes, which means that the trades are in a greater demand now than they ever have been in the past. In addition, the pay rates for tradies has gone up substantially over the past couple of years, and those higher labor prices are reflected in the bid pricing that we're seeing on all of our rehabs that we're doing. The best way to avoid a low bid is to have more than one contractor come out to take a look at the job that needs to be done. This might be difficult for you to accomplish when you are trying to make a purchase decision and just trying to move quickly. You may also need to find a contractor that will be willing to walk through the home with you when you're doing your initial walkthrough, but don't expect that to happen for free. And the reason I say that is that if you're asking a contractor to provide a bid for a job that they may never get because you don't even own the property and may or may not even put a bid in on it, you cannot expect someone to come out and put that labor down walk through the property, spend a couple of hours putting an estimate together for you. You cannot expect someone to do that for you for free. My recommendation would be develop a relationship with a contractor that you can know and trust. This gets easier, especially once you've started doing work with them, because you'll know the quality of their work and how accurate their bid pricing is, and that'll make it a lot easier for you to bid projects in the future. In addition, as you start to grow, you'll start to understand what it costs to do certain things in properties, how much it costs per square foot to install flooring, how much a roof should cost, things of that nature, which will make it a little bit easier for you to actually determine what it looks like when it comes time to do a rehab on your property. When you're taking a look at the bids, make sure that you're reviewing them thoroughly to ensure that all of the job tasks are listed and detailed out thoroughly. What I mean initially by that is that you want to ensure that the contractor didn't exclude or forget any part of the job, and that the scope of work is very, very clear as to what is being done. It's very, very common for something to get overlooked when you're writing up a scope of work. That creates a point of contention down the road when you thought that you were paying for everything and you find out that, hey, there's another bill coming because we didn't plan for this. So make sure that you're taking the time to review your scope of work early on in the project before you sign off on anything, before you pay the contractor anything, to ensure that you understand what it is that you're buying and what it is that you're paying for. Paint walls is generally not going to be sufficient on a scope of work for our office. Paint 4 walls in living room with 2 coats of Sherwin-Williams agreeable gray in eggshell finish is much more sufficient. Obviously, you can tell there's a pretty substantial difference between those 2 lines. And you may be comfortable with somebody that just says paint walls. If you have a contractor you've worked with for years and that's how they write their estimates, then by all means, that might be something you're comfortable with. But when you're working with a new a new contractor, it's important to get as much detailed information as you can on those initial estimates so that it's very clear to everyone involved what you're looking to have done. It's going to help you to understand the true cost of the job, and that's going to make it a lot easier for you to make a strong decision when it comes to whether or not you want to move forward and purchase a property. The third mistake that I wanted to cover is not building out a team to help you in your real estate investing journey. Rome wasn't built in a day, and your real estate empire won't be built in a day either. There are a lot of key players that you're going to interact with along the way. For instance, if you are just looking to purchase your first rental, you likely need to have the assistance of a real estate agent, an insurance agent, an attorney, a mortgage broker, a home inspector, possibly a title company, depending on the state that you're in. There are a lot of players in the mix right from the get-go. Beyond that, you might also be talking to property management companies, contractors, an accountant, a tax professional, etc. And building out that strong team of professionals is going to be critical to your success as an investor. Most people typically start out by interacting with or meeting with a real estate agent or a lender. And this is actually a really, really good place to start. The reason that I say that is typically real estate agents and lenders have a good network of their own that you may be able to leverage and access just by working with them for your purchase. For instance, most real estate agents know 2 or 3 really good home inspectors in your market. And those home inspectors are going to be the ones that are honest about the property, but also don't try to scare you away from buying a property by blowing things way out of proportion. There is a mid-ground there. You want to know what's going on when the property's inspected, and you want to know what the extent of the damage is or what you need to do to repair it, but you don't want someone that's just going to scare you off because there's a little bit of chipping and peeling paint or something along those lines. Different home inspectors operate a little bit differently, and that's one of those key areas because that's going to help you to highlight what you need to do to get that property rehabbed. You may or may not want to use the recommended vendors that your real estate agent or your lender or your property manager are working with, but it is generally a good place to start because more often than not, those people aren't working with people that are slouches. They're only working with people that are going to go out there, are going to get the job done, because that person is a direct reflection on the person who issued out the referral. So that's generally a good place to start when you're looking to build your team. Another good place to start is with real estate investor meetings. Interacting with other investors is going to help you build out your network rapidly, which is also going to help you access things like off-market real estate deals, investor-to-investor style deals, things of that nature. They can help hook you up with better vendors or vendors that you wouldn't necessarily know about and things of that nature. Usually these investor meetings are in the evenings, and you can typically find them on Facebook groups for real estate investors in your area, or on Bigger Pockets, or even just doing a quick Google search for investor meetups in your area. Some of them are free, some of them charge. Generally speaking, the charge is low. and any knowledge that you gain is well worth the cost of entry. So I would not hesitate to jump into a real estate investor meetup if you haven't been out to one already. The fourth mistake, and this is a big one, is over-leveraging yourself or having insufficient cash reserves. Over-leveraging is essentially taking on too much debt to finance a property purchase. Everyone wants to use OPM, everyone wants to use other people's money whenever possible, but taking on too much debt can be very, very risky to you as a real estate investor. If the property doesn't generate enough cash to cover the debt payments, you may be forced to sell the property at a loss, or you're going to default on that loan. In fact, some banks now look at the DSCR, the debt service coverage ratio, to determine if a property is going to be bankable or not. The DSCR is going to be your net operating income without factoring in your mortgage, divided by your mortgage payment. Essentially, it looks at how many multiples can you cover the mortgage by after taking care of the typical operating expenses. So most lenders are going to want to see at least a 1.2 DSCR, meaning after paying your operating expenses, you can still cover that mortgage 1.2 times over. Not having enough cash reserves is probably something that every real estate investor has experienced at some point in their career, because real estate is a cash-heavy business. There's no other way around it. Investing requires cash reserves to cover unexpected emergencies, such as repairs, vacancy periods, and things along that line. You should also be factoring in for some unexpected expenses and your vacancies and your repairs when you're doing your net sheet. So some of this stuff shouldn't necessarily come as a surprise, because you should have some reserves in place to take care of these things when they do pop up. All of this, of course, before taking into account the actual expected expenses, or having a big capital expenditure that you're preparing for, or something along those lines. As a rule, many investors recommend having at least 6 months of operating expenses in your cash reserves. Others will recommend having at least $1,000 per unit. Others will recommend some crazy formula that they've developed over 30 years of investing or whatever. But the best guideline that I can give you is to have cash reserves that meet your needs. So if you have a roof coming up, a roof replacement coming up, your CapEx account should be probably pretty well funded much higher than it typically would be for a property that, for instance, you just did a top to bottom flip and fix on it. Fix and flip on. So like if you have a property where you're not expecting major maintenance, you probably don't need to have a CapEx account that's quite as high as what you would have if you were going in to get ready to do a full-on rehab. That being said, you should always have some sort of funds available to you in the event of CapEx emergencies, such as a blown hot water tank, or something happens to your power grid, or something along those lines, plumbing issues. There's a lot of different things that can happen inside of a property or outside of a property, between the property and street, that you need to take make some plans to be prepared for, essentially. So my recommendation would be to have property reserves, have cash reserves for your properties. The absolute worst thing that you can do is to have no cash reserves, and that's a surefire way to set yourself up for failure. As far as what you feel you need to have on hand, that's going to be based on your property, your investing criteria, and your risk tolerance. But my recommendation would be to make sure that you have at least $1,000 per door inside your reserve account. And if you know that you have a big CapEx coming down the pipeline, I would make sure that you fund it even higher than that. The final mistake that we're talking about today is not having accurate record keeping. This could be for accounting, for maintenance, for leasing, any of the above really, but not having accurate records is only going to complicate your life down the road. Sure, sometimes you just want to get a contractor started and you don't want to worry about the W-9 and you don't want to worry about getting that insurance paperwork on file, but that does bite you down the road when it's time to file your taxes and it's time for you to issue out a 1099 to that contractor. Suddenly they don't want to give you a W-9 anymore because they know that they're going to be looking at a big tax bill if they take that 1099 from you. They think they can avoid the 1099, avoid paying the taxes on the income if they don't give you that W-9, so you can't issue that 1099 out. That's another topic for another day. But the point is, the longer you keep inaccurate records, the deeper the hole is that you have to dig yourself out of when you start trying to clean everything up. Speaking from just an accounting perspective, there are a lot of things that pop up when you start keeping inaccurate records. Obviously, the IRS can audit your records whenever they want to, and real estate is a targeted category for audits, so you're going to want to keep accurate accounting records simply because at some point you may be contacted by the IRS. They don't usually play games. Not having solid financials can lead to bad financial projections on properties that you're considering for purchase, or prevent you from getting financing on a property that you want to purchase simply because you can't prove your income and expenses or can't prove whether or not you're profitable. Missing deductions along the way can also result in a higher than necessary tax burden, which obviously no one wants. And accurate records can also help you in a lot of legal disputes, especially if you're the only one that has records to be considered. When you're the only one with records, your records are the only ones being considered. That's something to keep in mind. People lose paperwork all the time. And if you have paperwork and the other person doesn't have paperwork, that's probably going to look better on you in the courtroom, depending on whether your paperwork is good or not. So that's definitely something that's important. Missing records makes it hard to prove things. So keeping accurate records is going to be really important to your overall success as a real estate investor. So there you have it. There are so many ways that you can misstep early on as an investor, and hopefully we've helped you to avoid some of those pitfalls along the way. Did we miss anything on our list? Is there something that caught you off guard when your business when you were getting it started? Do us a favor, drop us a comment down below and let us know. Don't forget to like and subscribe. I'm Andrew Schultz with RentPrep.com, and we'll talk to you soon.